All right, let's talk about something that trips a lot of people up. You get how a bank works, right? It's simple. But the stock market, that can feel like a whole different universe. Well, today, we're going to bridge that gap and make it all make sense.
So let's get right to the heart of it. We all know what happens when a bank pays you interest. But when a company you've invested in pays you a dividend, is that basically the same thing? It's a great question, and we're going to break it all down. First up, let's kick things off with the big one, how the money actually finds its way into your pocket. Because believe me, the way a bank pays you and the way a company pays you are two totally different stories. Okay, so here's the core difference. It really comes down to one thing, a promise. When you put your money in a bank, they make you a legally binding promise to pay you that interest. They have to. With stocks, there's absolutely no guarantee. A company's board of directors gets to decide if they want to share their profits, and if so, how much. It can change every single year. And this isn't just some textbook theory, right? Let's see how this actually plays out in the real world. We're going to look at a hotel company, and this example, well, it really shows you just how unpredictable things can get.
So, in 2019, things were looking great. If you owned a single share in this company, they paid you a dividend of 119 rupees. Not bad at all, right? A pretty solid return.
But then, bam, 2020 hits. The pandemic crushes the travel industry, and the company's profits take a nosedive. And just like that, the dividend for that exact same share plummeted to just 50 rupees. That's less than half of what you got the year before. So what's the bottom line here? It's all about certainty versus potential. A bank gives you certainty. It might not be the most exciting return, but you know it's coming. Stocks, on the other hand, offer the potential for much, much bigger returns, but that potential is completely tied to how well the company is doing. And get this, some of the most profitable companies in the world pay no dividend at all. They just reinvest everything back into growing the business.
Okay, so we've got the profit part down. But what about taxes? You know, the part where the government wants its cut? Let's see how that compares.
And this is where things get really interesting. With bank interest, it's super simple. You've got one kind of tax to worry about. But with the stock market, there are two different ways you can get taxed, and that's because there are two different ways you can make money.
Let's break that down real quick. First, you have capital gains. That's the profit you make when you sell a stock for more than you paid for it. It's the classic buy low, sell high scenario. Then you have dividends, which we've been talking about. That's the cash the company pays you just for holding onto the share. Each one has its own tax rules.
Now listen up, because this next part is a huge deal, especially if you're thinking about investing for the long run. This is a real game changer.
Yup, you're seeing that correctly. In Pakistan, if you buy a stock and you just hold it for over 4 years, when you finally sell it, the capital gains tax you owe on your profit is zero. Zilch. Nothing. It's an incredible incentive to think long term.
All right, profits, taxes, check and check. Now let's learn to talk the talk. To really understand the market, you gotta know the language. So we're gonna decode 3 key terms you'll hear all the time.
First on the list is face value. Think of this as the share's birth certificate price. It's the original nominal value from the day the company was born, usually a tiny number like 10 rupees, and it pretty much never changes.
And here is exactly why that little number matters so much. When a company announces a dividend, it's a percentage of that tiny 10 rupee face value, not the price you actually paid for the share. So if they announce a 300% dividend, you might get excited, but that's 300% of 10 rupees, which is just 30 rupees per share. It's a massive difference and a classic rookie mistake.
Okay, next up, book value. This is basically what the company is technically worth on paper. Imagine if the company had a giant everything-must-go sale. They sell all their buildings, all their equipment, empty their bank accounts, and then they use all that cash to pay off every single debt they have. Whatever's left over for the shareholders, that's the book value. And finally, the big one, market value. This is the number you see splashed across the news every day. You just take the current share price and multiply it by all the shares that exist. This number is all about perception. It's what all the investors out there collectively think the company is worth right now based on its future potential.
So, after all that, where does this leave us? What's the next step?
Look, the whole point of this wasn't to say one is better than the other. It was to show you that banks and the stock market are two completely different games, with different rules, different risks, and different rewards. One offers safety, the other offers the potential for incredible growth. So the real question isn't which one is best. It's which game is right for you and your financial journey.